Awesome.
Hello,
All right.
everyone. Welcome back. We are joined now by Terra Capital, and we are very excited to hear their presentation. So, team, you will have 10 minutes for your presentation today. I will begin timing when the first person starts speaking, after which we will move into a 20-minute Q&A. So, best of luck.
Perfect. Thank you, Tina. We can get started then. Good morning, everyone. Thanks for joining us today. Our team from Terra Capital, who you met earlier through our video introduction, is really excited to walk you through a decarbonization strategy that we believe will be both sustainable and impactful for Super Easy. So to kick us off with our proposal objective here, Super Easy's request for a net zero pledge design and an approach to decarbonization was in itself a really great acknowledgement of several major shifts our team had actually been seeing around the world through our market assessments. So beyond the accelerating climate crisis, we've also been seeing a range of government initiatives in addressing fossil fuel use, everything from massive tech investments to instituting carbon pricing, as well as a heightened sense of awareness and long-term risk sensitivity among our investors. The global tech ecosystem, which was already growing pretty quickly, has been accelerated by the recent pandemic, so we're really well positioned to see many major innovations in the coming decades. You'll also notice that we've recommended some modifications to Super Easy's investment philosophy, which of course currently focuses on low-cost management and risk-adjusted returns. Our suggestion is to actually layer in inflation adjustment to that second tenet, as well as the addition of a brand new focus on consistent reevaluation. This last pillar is something you'll see us mention throughout the rest of this proposal. Very quickly, we did also want to highlight that the additions to the investment philosophy are intended to maintain the existing relationships with current fund holders while also creating a new basis for value alignment for future investors as well. Now, before we get into the meat of the strategy, we do want to set the stage by actually defining our target, which is Super Easy's net zero pledge. Based on our assessment, a commitment of net zero for scope 1 and 2 emissions by 2050 is both feasible and achievable. And to support Super Easy's road to net zero, we've also included 3 milestone markers as measures of success along the way, all of which focus on carbon intensity reduction. Basically, by 2030, we'll aim for a 27% reduction, ramping up to 73% by 2040, and finally, of course, hitting our holistic 2050. Now, throughout the proposed approach, you want to keep your eye out for the 4 key initiatives that we've highlighted, including active stewardship, portfolio rebalancing, green bond issuance, and an ongoing integration of net zero targets as the fund evolves. The outputs of this strategy are projected to reach stable returns of 8.76% with a standard deviation of 10.37%, while also achieving a Sharpe ratio 1 basis point higher than our current levels. I won't spend too much time on this slide. I did want to call out that the approach we are recommending is multi-phased in order to maximize feasibility and implementation success while avoiding any significant risk to returns or shockwaves to the Australian economy. I'm going to pass it on to my colleague Jay to take us through phase 1 of our approach.
Thank you, Sarah. In phase 1 of the decarbonization strategy, we advocate no changes to sector allocation and no active divestment of carbon-intensive equity holdings. Rather, we suggest Super Easy engage with its primary holdings to establish decarbonization pathways and lay the foundation for active stewardship in phases 2 and 3. Within the organization itself, we advise Super Easy to hire a chief sustainability officer, declare its net zero commitment to the public, create an external advisory board to monitor its progress, and set up a wholly owned subsidiary for green bond issuance. Lastly, we recommend making some adjustments to the investment portfolio to integrate ESG considerations and strengthen diversification. The weight of public equities will be reduced from 48% to 45%. 3% of the fund will be earmarked for green bond investment. The fund will also shift some assets from sovereign bonds to ESG-focused global credit. Moving on, I'm going to elaborate on Super Easy's green bond initiatives. The setup of this wholly owned subsidiary will enable Super Easy to have greater autonomy and flexibility when investing in green ventures than a typical superannuation has. The debt issuance will be roughly equal to Super Easy's 3% green bond allocation, with potential opportunities for external investors in the future. Furthermore, the creation of an independent green bond council is intended to provide specific expertise to guide the subsidiary's investment decision. Next, I'll let Echo carry on the discussion of the decarbonization plan.
Thank you, Jay. Going to phase 2, Super Easy will continue to influence and train its bestie company through active stewardship. By 2030, after almost a decade on this journey, the companies are expected to have established and start implementing their net zero transition plans and disclose their carbon emissions through better aligned and transparent reporting. So, starting from the second phase, Super Easy will evaluate the companies against various forward-looking metrics and based on the performance, make active divestment and investment decisions. As part of this ongoing assessment and portfolio rebalancing, we do foresee that in phase 2, companies in the carbon-intensive sectors are still more likely to underperform, and the bottom quintile that show little or lagging progress on emission reductions will be divested, and the released funding will be reallocated toward the emission-light industries. Lastly, net zero integration will be expanded to the entire portfolio, including alternative investments, and the strategy implementation to the public equity and fixed income holdings will continue and integrate both existing and newly acquired funds. When it comes to alternative investments, Super Easy is overall in a stronger position to influence actions through ownership and partnership with key stakeholders. The private equity portfolio is less driven by short-term financial reporting results and does provide investees with more flexibility to follow Super Easy's guidance and decarbonize. Real estate properties and infrastructure financing investments are physically more vulnerable to climate changes, therefore it's more imperative to weigh towards green projects. Entering 2040, we project the global landscapes will change in unimaginable ways, where technology has significantly evolved, many new investment opportunities have arisen, and data availability required to facilitate net zero integration have greatly enhanced. Under such context, we suggest Super Easy to continue with the 3 pillars from Phase 2 and keep evaluating its emission reduction targets and decarbonization approach to ensure they remain relevant and effective. Though opposite to Phase 2, during the 3rd decade, we suggest upweighting allocation to the traditional carbon-intensive sectors and companies which have successfully made the green transition, because these sectors by then could look strikingly different from today, driven by all of the evolutionary technology breakthroughs that take place during Phase 1 and 2. This will increase Super Easy's portfolio diversification across industries and potentially generate higher investment returns. Now I'm passing back to Jay to highlight the successful approach.
As you can see from the chart on the left, based on Super Easy's current portfolio structure without any adjustments, we estimate the fund can earn an annualized return of 8.8% by 2030 with a volatility of 10.7%. The chart on the right illustrates after implementing the decarbonization strategy, the fund can continue to produce similar returns in all 3 phases and maintain its risk profile as a balanced fund. Thanks to the adjustments implemented in Phase 1, the portfolio will enjoy slightly lower volatilities than the existing portfolio and thus higher Sharpe ratios. Next, we are going to look at the fund's carbon intensity. We anticipate the portfolio decarbonization rate in Phase 1 will be low, as investee companies will need time and resources to attenuate the carbon footprint of their operations. In Phase 2, the entire portfolio will see a meaningful drop in carbon intensity as active divestments and active stewardship activities are conducted. We recognize that an additional emission reduction of 11% will be required to align the fund with the proposed net zero pledge. Nonetheless, we believe further decreases will materialize through carbon offsets and technological breakthroughs. Now I'm going to pass it on to Joe to talk about risks and trade-offs and the next step for Super Easy.
That's great. Thanks, Jay. A great deal of consideration and thought was given to crafting this investment strategy. We'd like to discuss some of the key risks and trade-offs that were center stage during our analysis. Oftentimes, funds that choose to decarbonize run the risk of limiting diversification. Rather than choose one over the other, our belief is that Super Easy can stay invested in fossil fuels and create a positive dialogue with the companies in which it invests. Working with these companies can induce positive change over time. Global fossil fuel demand is high, with the majority of developed nations relying on fossil fuels to power their economies. With that in mind, widespread divestment can be counterproductive, as it may cause capital constraints and make it more difficult for fossil fuel companies to invest in cleaner extraction. Another debate centers on sacrificing expected future returns in the name of achieving net zero. We do not believe that meaningful expected future returns and carbon neutrality are mutually exclusive propositions. The changes suggested in this proposal are expected to improve portfolio diversification and deliver attractive returns over the long term. On the subject of domestic versus foreign stocks, resource stocks are a significant portion of the Australian economy. These companies employ numerous potential fund holders who are less likely to invest in Super Easy if Super Easy doesn't invest in them. Aligning with the 3-phased investment strategy in this report, Super Easy can stay invested in domestic stocks, issue a call to action to reduce emissions in Phase 1, and reduce exposure to domestic stocks in Phases 2 and 3 if necessary. As we wind down our pitch today, we want to acknowledge that we're relying on several assumptions for this long-term decarbonization strategy. But given the existential climate crisis we're facing, governments and firms are left with little choice but to reduce their carbon emissions. This is why we believe we'll see dramatic changes to the energy sector in the coming years. The first step of Super Easy's journey involves establishing the fund's vision and firmly committing to achieving net zero by 2050. While having the vision is an essential first step, communicating that vision to all stakeholders is equally important. This message needs to be delivered to the entire organization, investees, and fund holders. Lastly, in the early stages of phase one, only minor portfolio changes are required, with more emphasis being placed on active stewardship with the portfolio companies. Looking down the line to phases 2 and 3, Super Easy must prepare for reshuffling within sectors and divesting from companies that aren't making progress on emissions.
So
with all
sorry,
this in mind,
to cut you off, but we've reached our 10-minute mark. That's
thank
all
you
right.
for your
We
time
do
today.
have-
We'd like to take your questions.
Right, we do have time for a Q&A, so that will be your chance to maybe wrap up your presentation if it relates to a question. So now 20 minutes on the clock, and judges, who would like to open with the first question? Francis, go right ahead.
Yes, thank you for your presentation. I have a question, well, maybe just an open-ended question about the asset allocation of your strategy. What is the impact of the new investment on the asset allocation? How much you're going to allocate to them, and how will that impact the expected risk and return of the portfolio?
Yes, I can take that question. Sarah, can we go to Appendix G1, please? So as you can see in this table, under 2022, we have the existing portfolio structure, and under 2030, 2040, and 2050, we have the adjusted portfolio structure after implementing the decarbonization strategy in phase one. The weighting of each asset class will remain unchanged in phases 2 and 3 after completing the portfolio adjustments. Decarbonization activities in phases 2 and 3 will be conducted through sector allocation and security selection. To reiterate, we propose no changes to sector allocation and no active divestment of carbon-intensive equity holdings in phase 1, but we do recommend making some adjustments to the portfolio to integrate some ESG considerations and strengthen diversification. As you can see, under public equities, we reduce the weights of public equities from 48% to 45% by reducing 1% from each category. At the same time, weights income from 17% to 20%. So, and then we also we're going to reduce some Australian sovereign bonds and international sovereign bonds and make that up with an upweights in global credits with ESG focus and green bonds. So as you may wonder that why we do that, because reducing sovereign bonds can signal to the Australian governments that we want change instead of just relying on a passive approach to decarbonization. And then with the reduced sovereign bonds weight, there's going to be some increased volatility. So we reduce the weights of public equities to balance the volatilities of the overall portfolio. I hope that answers your question.
All right, thank you very much, team. Our next question comes from Karen. Please go ahead.
Thank you.
I just want to add to Francis's question, which is you've added an additional objective, which is not only risk adjusted but also inflationary, right? And I just wanted to see it in the asset mix. Is how are you addressing the inflation bit to the asset mix over time? Thanks.
Yes. Actually, like our asset return forecasts account for the impacts of climate change, which include physical damages, energy transition, and impacts of public policy and the impact on macro variables such as level of GDP. Like for equities, we take equity risk premium into consideration in setting return expectation. The equity risk premium is calculated using some implied cost of capital approach with inputs such as discounted cash flows, today's market price, expectations of future dividends, and growth of interest rates. Change in equity valuations are driven by both expected cash flows in earnings and dividends and equity risk premiums. So the equity risk premium would take into consideration the current underlying economic condition and the interest rate environment.
And actually, if I may build on that, on the subject of inflation, we believe that super easy investors want to enjoy financially stable retirement. In order for that to happen, they really should be more interested in real returns in order to preserve their buying power. So aiming to exceed the rate of inflation over the long run gives super easy more leeway when considering green investments today that may not be profitable today, but are potentially profitable down the road. And this is in contrast to a fund that's aiming to achieve short-term benchmarks. There's also precedent for this approach with Oxford University Endowment Management following a similar methodology. Now, our long-term returns are forecasted to be approximately 8.76%. Although inflation is currently elevated, we believe this is a temporary phenomenon resulting from supply chain disruptions and pent-up excess demand resulting from COVID lockdowns. We also know that central banks across the world are committed to quashing inflation. We've seen this with aggressive rate hikes from the US Federal Reserve, the Bank of Canada, as well as the Reserve Bank of Australia. So it's rational to believe that over the longer term, inflation will subside and normalize.
All right, thank you very much, team. And just a brief reminder to our judges, I know Q&A can be very exciting and we want to jump in with questions, but rest assured that I will take everyone in turn. So Karen, very sorry about that earlier. Please proceed with your question.
No problem. Thank you very much for the presentation. I have a question regarding your green bond program. Just walk me through the benefits of green bond issuance. Is this a way to add leverage to your plan as opposed to just buying green bonds or just outright investing directly in the assets, as you do need a green use of proceeds for a green bond?
Yes, I can. Sorry, I can also take that question. Sarah, can we go to slide 8, please? The green bond subsidiary structure. So as you can see here in this diagram, we're proposing super easy to set up a wholly owned subsidiary for green bond issuance. The setup of this wholly owned subsidiary will enable super easy to have greater autonomy and flexibility when investing in green ventures than a typical superannuation has. The subsidiary will also augment super easy's influence as a global investor to create supportive and sustainable environments. Another objective is to super easy can take a leadership position amongst global investors to shape ESG standards and better understanding the transition to low carbon economy. With a subsidiary, the super easy will lend money to the subsidiary so that the subsidiary will invest in various kinds of green projects as identified at the bottom of the slide. 5 types of project categories: renewable energies, green transportation, energy efficiency measures, forest, agricultural, land management projects, and green buildings.
All right, thank you, team, for that response. Our next question comes in from Patrick.
Thank you very much, team, for a great presentation. 2 quick questions. Can you precise a little bit the role of this CSO that you think you should hire, and how does he interact? Would he interact, or would she interact with the CIO? And second question is, how does and would the pricing of positive externalities and negative externalities pricing influence your asset allocation?
For sure. And so I can take the first half, and then one of our team members can take the second half as well of that question. So the role of the CSO is part of our foundational phase here. We strongly believe that the phased approach that we're taking is in order to set up a long-term sustainable success for the fund in this transition for their priorities and the way that they're approaching their decarbonization. We have seen several major funds around the world implement a similar strategy by bringing in strong leadership as they change their strategic direction here. The chief sustainability officer would work in close partnership with the CIO when they proceed with setting up a lot of the things like the External Advisory Board, the Green Bond Council, helping set the direction for the evaluation matrix for those forward-facing metrics. So as you would have heard colleagues Echo and Jay mention, through the phases, a lot of those holdings will be held to hit certain decarbonization targets. And so the CSO's role is in helping to lead that that conversation. And also on the flip side, helping to define Super Easy's position domestically and internationally for the changes of their fund. So it's really making sure that internally and externally, the fund is set up to have a sustainable change.
All right, thank you, team, for your response to that question, and thank you, Patrick, for that question as well. Our next one comes in with Kelly. Go ahead.
Thank you very much. Well, firstly, congratulations on making the top 5 and for your presentation. You've all clearly put in a lot of work into your proposal, which is great. So my question is, how could your proposal fail?
Joe, do you want to talk about some? Go ahead.
Yeah. Just unmuting there. So when we ran through the risks and trade-offs in the presentation there, we know, and again, we're relying on a few assumptions for all this to happen, right? So the key point here was that right now there is an existential crisis that's brewing, and a lot of these companies will have no choice but to decarbonize, or at least put in place measures that put them on the path to decarbonization. So we are relying on some technological leaps. And even in that decade of 2040 to 2050, we're relying on technology that yet we can't imagine. And Echo commented on this as well. We don't know what the world will look like at that point, but we think it's going to happen based on the trajectory we see now, based on the money, the research, and the time that's being devoted to this subject. So that's one of the ways in which we could see it failing. But I'll circle back to the point we made in the presentation about, oftentimes it's looked at as either we decarbonize by divesting or we stay invested and then hope for the best. Our approach bridges that gap. We think we can stay invested for now and work with these companies to help induce that positive change. There's nothing set in stone here that's going to happen, but we feel that this is the best option we have at this point. So that's one of the ways we could see this failing, but we did give this a lot of thought and careful attention, and we believe this is the best approach for now.
All right, thank you, team, and thank you, Kelly, for that very important question. Our next question comes in with Jamie. Please go ahead.
Thank you, and great presentation, team. So my question is coming back to the theme of inflation, and I really like the idea that the outset not changing, sector allocations, but I did notice, I guess, going into phase 2, sector allocation towards energy, utilities, materials, like those are and industrials are falling. So how are you thinking about the inflation hedging benefits of those sectors, given that you'd be making this trade-off or taking on almost like an omitted variable bias on commodities in your portfolio?
Thank you, Jamie. I can take the question. So if we go to Appendix C.1, so this table essentially shows more details in terms of how we will be making our sectoral reallocations over the 3 phases. So for example, like in phase 1, as you can see that we're not going to make any sectoral allocations because of the rationales that all my colleagues have mentioned earlier. And starting in phase 2, across the 4 relatively high carbon incentive sectors in energy, utilities, materials, and industries, we will be taking 20% of their existing weight and reallocating to the relatively light emission industries. And in phase 3, in light of all of the technology breakthroughs that we projected, we will upweight the allocations to these sectors and pretty much back to their current level in the Super Easy's portfolio structure. And to your question, Jamie, regarding how we're going to make sure that the inflations, so the inflation nature of these energy utilities sectors will still persist in our portfolio. It's not that, so during phase 2, even though we're going to reduce the weight for these 4 sectors by 20%, because that is based on the assumption that even by phase 2, companies in these sectors, some of them, like at the very bottom quintile, will still, relatively perform poorly compared to their peers and also compared to the other sectors. But we will, within each of the sectors, we will also make portfolio rebalancing to make sure that within of the sectors we have enough positions, and we will invest in the best performance within these industries. So we believe that the 20% weight reduction from these sectors will not significantly impact the inflation dimension from our portfolio. Hope that answered your question.
Great, thank you, team. I think we have time for 2 more questions and then perhaps a follow-up for you, Patrick, if we get there. But let's begin with Vincent.
Thank you. So my question is related to Scope 3 emissions. Can you just explain to us why you have decided to exclude Scope 3 from the net zero target in 2050?
So go ahead, Echo.
I'm sorry, I actually just want to clarify the question. So are you were asking that what initiatives that we'll be taking in Scope 3 to make sure that we can hit our net zero target?
My question was more related to the targets that you've set. From my understanding, you are focusing on Scope 1 and Scope 2 emissions. So what's the thinking behind that?
Yeah, absolutely. So I think with the approach that we were taking, that we've actually applied broadly across our entire proposal, is to ensure that there's a sense of realism and achievability in what we are proposing to Super Easy. Scope 1 and 2 are the most realistic target measures that we can achieve because they are direct and to the indirect measures that as far as our active stewardship that we had mentioned can take us. Scope 3 lies a little bit beyond the levels, at least with the information that we have today, to embed in a comprehensive target for Super Easy. So we were just trying to ensure that whatever proposal we're putting together for the fund actually does have a sense of realism in the way that it can be implemented. If that answers your question, Vincent. Let me know if there's anything else that you want me to elaborate on there.
Thank you. That's great.
All right. Thank you very much. Next question, Paul. Go ahead.
Thanks for a very interesting presentation and many congratulations on getting to the final. My question was around your equity allocation through the pathway to 2050, and particularly interested in your comments around keeping the allocation to emerging markets fairly consistent. I think it goes from 11 down to 10, but you hold it at 10 through that. I might have expected you to reduce EM when you're trying to reduce carbon, but I'm just interested in your view on that one.
Yeah, I can take that question. So if we go to Appendix G.1, if we look at this allocation across Super Easy's portfolio, we can see that we actually have reduced the exposure to international emerging markets by 1% from the current level at 11%. And to your question, Paul, we do believe that keeping our exposures within the emerging markets will be actually in the long run be beneficial, and generate net benefits for our portfolio and for our investees, and also for the environment. Because we do foresee that even though some of the emerging markets, for example, India and China, they have made their net zero pledge, but which is in their timeline is a little bit behind the in developed countries, like they have set 2060 and 2070 as a timeline. But we do believe as a pension fund, we have the responsibility to keep our exposure to these companies and help them materialize with their decarbonization strategy. Yeah, hope this answers your question.
And if I may just jump in and add to that, so we also believe that, remember, we're staying invested in domestic Australian resource stocks in the early phase at the very least, and we've also elected to work with these companies. We believe that because of Australia's knowledge in this area, they're well equipped to develop breakthroughs in cleaner extraction and then in turn export that to the world. So everything that Echo said applies, but we're also trying to work with our domestic companies, hoping that they can make some breakthroughs. In turn, that can get exported to the world.
All right. Thank you very much, team. We do have time for one final quick question. So Patrick, take it away.
Thank you very much. Actually, I was interested in the investment philosophy description that you had at the beginning of the presentation, in particular phase 3, or not phase 3, but the third element of it, which is the consistent reevaluation. On what criteria would you reevaluate that approach?
Sorry, Patrick, just take us back there. Yep, go ahead.
Yeah, I can definitely take that question. Just because there will be, as mentioned by all of my colleagues and during the presentation, we do foresee that there will be a lot of uncertainties and upcoming technology breakthroughs that will be materializing over the next 3 decades. So in assessing and evaluating our investee company's performance, we believe that we do not want to simply take a snapshot of the companies, of where the companies are as of today. For example, what is their carbon intensity today? And because that only show a small part of the picture. Instead, over time, we recommend Super Easy will be on an ongoing basis, assessing the companies based on a basket of forward-looking metrics that could provide us a more holistic view evaluating this company's commitment and effort towards transition to net zero. For example, we will look at how they have established their net zero targets, if they have robust implementations in place, if they have set up proper emission measurement and transparent disclosures, and how much investment they will commit to conducting green activities on their roadmaps. So by looking all of these criteria and assessing these companies on an ongoing basis inside, and also looking inside our portfolio, and also look at their peers in the industry. So we believe that will be a more robust approach to make sure that our strategy will stay intact and could achieve our net zero targets in the long run. Hope that answers your question.
Thank you very much, team. Unfortunately, that's all the time we have for the Q&A portion today, but excellent presentation, wonderful work making it to the finals. And thank you all the judges as well for your great questions. Everyone, we will now be taking a 10-minute break before we welcome on our next competitor, Terra Capital. So please feel free to take this time to grab some water or coffee. We'll be back with you shortly.
Thank you very much.